This is a video analysis of RPC Inc. as part of Burkenroad Reports, a program of Tulane University A.B. Freeman School of Business. The analysts for this report include Allie Hewitt, Andrew Johnson, Danielle Naricki, and Stephen Brookman. Today, we are first going to give a brief company description, then we will go over the methods we used in our valuation and discuss the stock price and our projected target price. Then, we will go over RPC's investment strategy, and finally, analyze the potential risks that burden RPC and the oil and gas services industry as a whole. RPC Inc., which trades under the ticker RES on the New York Stock Exchange, is headquartered in Atlanta, Georgia. RPC provides a range of oil field services and equipment rental to both independent and major oil field companies in exploration, production, and development of oil and natural gas. As of the release of this report, RPC was trading at $17.85, and it has a market cap of approximately $3.96 billion. It has approximately 219 million shares outstanding. In 2012, RPC had approximately $568 million of available liquidity, consisting of approximately $388 million of accounts receivable, $141 million of inventory, and $14 million of cash and cash equivalents. RPC had capital expenditures totaling approximately $329 million in the past year, which is a conservative value compared to the capital expenditures of its peers. Insiders at RPC own approximately 72% of RPC shares, and on June 5, 2013, RPC had announced an expansion of its stock repurchase program. RPC operates in two segments, technical services and support services. However, approximately 93% of the revenues are generated from their technical services segment, which consists largely of pressure pumping, downhole tool services, and coiled tubing services. RPC's pressure pumping operations account for 54% of the revenues. RPC operates in various regions across the United States and select international markets. However, going forward, RPC will focus its services on the Permian Basin, the Eagle Ford, the Marcellus Shale, Haynesville, and the Bakken Shale. Our team of analysts used several models to determine the valuation for RPC. The first method our team used was the dividend discount model. Due to a special dividend paid in Q4 of 2012, the recent dividend growth rate is exaggerated. To adjust for this anomaly, we used the two-stage model, resulting in an expected equity price per share of $19.04. RPC has given quarterly dividends over the last 15 years, making the dividend discount model a strong tool to evaluate RPC's value. Next, our team used relative multiples to compare RPC's price-to-equity and price-to-book value ratios to its competitors. After comparing RPC's price-to-equity ratio to companies like Patterson Energy, Key Services, and Superior Energy Services, our team calculated an estimated price per share of $17.19. Our team used the same method for price-to-book value, resulting in an estimated price per share of $20.99. Because oilfield services is a highly specialized industry, relative multiples is an appropriate method to estimate the proper valuation. Considering all three valuation methods used, we determined the 12-month target price for RPC's stock to be $19. The current price is $17.85. Our team of analysts used two methods of valuation, discounted dividends and relative multiples, to calculate three estimates for the price of RPC's stock. To diversify our estimate, we evenly weighted the three estimates. The weighted average of the estimated prices is $19 per share. Our estimate of $19 results in a forecasted stock return of 6.44%. We estimate a 12-month dividend payout of 41 cents. Including the dividend payout, the forecasted return climbs to 8.73%. Our estimated performance of RPC earns a grade of market perform. RPC has four main tactics that make up its investment strategy. First, RPC's shift to horizontal and directional drilling increases the value of RPC's services. Second, RPC maintains financial stability through conservative allocation of PP&E expenditures. Third, RPC's shift towards oil shows the company's flexibility. And fourth, RPC's stock repurchases signal slow growth and internal confidence. RPC excels in providing services to complex drilling systems, such as those used on directional rigs. Over 2012, North American oil and gas rigs have shifted away from traditional vertical rigs to more efficient horizontal and directional rigs. Vertical wells decreased by 23% in 2013, and the directional rig count increased by 19% from 2012 to 2013. The higher percentages of horizontal and directional rigs in North America offer many opportunities for RPC to provide its specialized field services. RPC emphasizes a capital structure that enables management to react quickly to the ever-changing oil and natural gas market. To maintain a highly liquid capital structure, RPC decreased expenditures in PP&E by $18.2 million in 2012. By maintaining a conservative capital structure and low capital expenditures, RPC takes on less risk at the expense of growth. This position makes RPC less vulnerable to financial risk when the prices of oil and natural gas are down. RPC's recent shift toward oil services is evidence of the flexibility of RPC's employees and assets. RPC's specialized oilfield services shifted from a focus on natural gas towards oil because of the low price of natural gas. The price of natural gas reached a low of less than $2 per MCF in March 2012, but has since stabilized around $3.50 per MCF, which is still to attract additional drilling for natural gas. With the volatile nature of oil and natural gas prices, RPC's long-term success in the industry is dependent on being able to move seamlessly between providing oil and gas services, which the company demonstrated greatly in 2012. Although management's stock repurchase program is a sign of confidence in the company, it also signals limited growth opportunities. Although the repurchase program effectively makes RPC a more closely held company, the stock repurchase program is another example of RPC's conservative capital structure. Management chooses to continue to repurchase stock because it is a tax-effective way of increasing the per-share value of the shares outstanding. Because stock repurchases create a liquidity issue, the company routinely engages in stock splits. Overall, this program returns earnings to the stockholders at the expense of funds available to support future growth. While RPC maintains a conservative investing and financing structure, the company is still vulnerable to certain risks. First, the demand for RPC's services depends on the oil and gas market movement and the overall demand for oil and gas. Second, inclement weather has the potential to affect and inhibit the company's operation locations. Third, because RPC's customers all operate in the same industry, there is credit risk that would occur with an industry-wide recession. And lastly, the oil and gas services industry may be affected negatively by increasingly stringent environmental regulations. This concludes our Burkenroad report. Thanks for listening.